Thank you, everybody, for attending our first webinar of 2024. We host this event each quarter on the third Tuesday of the month. And today we have ClearBridge Investments, who've been gracious to come on board to give a presentation on where they think the economy will be heading in 2024. And I'll just briefly say ClearBridge was our host a year ago, and the conversation was all about the recession and the recession that was going to take place. And as we could see in the economy and the stock market moves in interesting ways sometimes. So this helps us get perspective. We appreciate you attending. And once again, let me introduce Andrew Yauer and Corey Hardy, who will be giving the presentation.
Yeah, for sure. Thank you, Neil, and appreciate the time this afternoon, I guess, or no, we still are morning. No, we appreciate everybody's time. Yeah, just a quick introduction. We have Corey Hardy, who's actually with our ClearBridge investment team. Just a little synopsis of Corey. We actually had Corey join ClearBridge in 2014. He's got 11 years of industry experience and a wealth of knowledge when it comes to capital markets and economic analysis. So great use of your time today. You'll get some overview on different pockets of the market, where we see the propensity to maybe see some recessionary environment on the horizon. And then, of course, answer some of the questions and maybe demystify some of the key talking points that you see all over CNBC as well. So, Corey, I'll hand you the baton, and thanks again for your time.
Awesome. Thank you very much, Andrew and Neil. I'm going to go ahead and share my screen and we can get started with the content. Again, I'm Corey Hardy from ClearBridge, and I'm going to go over the anatomy of recession presentation, what to look for and where we're headed. So this presentation is very long. It's something like 70 slides. I'm going to break your heart right now and tell you that I'm not going to go through all 70 slides. I'm going to go through kind of a greatest hits version of this over the next half hour. And hopefully we're going to try to, like Andrew said, demystify some of the things that are going on in the market and the economy, and give you some direction as to what that means for your investments longer term. So when I say longer term, I really mean it. Part of why we created this presentation was to help people get over what we would call behavioral biases or investor pitfalls. And that's going to be the first part of the presentation. And we're going to start by laying out what we call panic attack scenarios. So these are scenarios in each year going all the way back to 99, where something happens. You can see in the middle of the chart, something happens that causes investors to go into a panic. And the second to right most column, you can see the S&P 500 during these panics tends to have pretty dramatic declines. And unfortunately, a lot of investors capitulate during those big declines, and they sell at the wrong time, and they kind of crystallize or lock in those losses. And it's a hugely capital destructive behavior. And I'd contrast that with the furthest right column, the last column, where you can see that if you had just held on, the cumulative return since the beginning of that year, so inclusive of that decline, is usually very, very meaningful over time. So hanging on to your equities through thick and thin really is the name of the game, and having the mental and behavioral fortitude to do that is so important. And that's why working with a financial advisor is really, really important. And unfortunately, a lot of people don't do that, and their investment results kind of show that. So the average investor going back 20 years has annualized just 3.1% returns. When you compare that to inflation, which is also on this chart all the way over here on the right, which is 2.5%, you have to net those two out, because if inflation is 2.5%, and you make 2.5% returns, your purchasing power is the same as it was last year. So you didn't actually make anything. So you have to think about your returns in the context of inflation. So if you think about it that way, the average investor didn't even make 1% each year for 20 years. And they did that as a result of behavioral biases. And you can see all the way to the left, ClearBridge is an equity manager, so this is very convenient for us. U.S. equities have been the best performing asset class, up almost 10%. So meaningfully in excess of inflation. So that's the way you maintain purchasing power, is having a diversified exposure. U.S. equities should be a big part of that, but a diversified exposure that you consistently maintain over some time horizon, not trying to kind of buy and sell. And unfortunately, people have a tough time with this. And as a result, you can see this Dalbar study shows average investor returns are pretty awful. But looking at it more kind of from year to year, you can see that the average return, sorry, my presentation is a little lagged. The median intra-year decline going back to 1983 is actually about 10%. So putting this differently, trying to make this as simplistic as possible, every single year, January 1st comes, you kind of head into your investment year, you should think, I should expect a 10% decline in the S&P 500 this year. If it doesn't happen, great. You know, half the time it's not going to happen, but half the time it's going to be worse than that. And you just should mentally be prepared for declines in the market. But declines don't equal a loss unless you sell at that maximum point of capitulation, like we talked about earlier. It's just part of the cycle. So you have to expect declines when you are invested in things like equities. And the important part is, if you are someone who can look past these, the median annual return over this same time frame is about 16%. So if you have the mental fortitude to hang on, you're well rewarded, but a lot of people don't, and they fall victim to those behavioral biases. The other thing I want to mention is, even if you do think you are the LeBron James of market timing, you can consistently get in about a year before the big moves higher, and get out about a year before the big drops down, which would be unheard of. You'd have to be an absolute legend to be able to do that every single time that the market had big moves up or down. You still would not do as well as a typical buy hold strategy. So if you just invested $100 at the beginning of this chart and just let it ride, you'd have a cumulative almost $36,000. But if you try to employ that buying and selling technique that we talked about a moment ago, and had historically great luck in terms of being able to time it within 1 year of big inflection points, you'd still have meaningfully less money at the end of it. And that's, again, assuming you're really, really good at it, which is pretty much impossible. So buying and holding is the name of the game, and putting time on your side is really, really important. And many people underestimate how much forgiveness the market will allow you over time. So this next slide shows you, if you have a doomsday scenario since 1950, let's just say you are historically unlucky, contrasting it with the prior slide, and for whatever reason, you go ahead and invest $1,000 every single year at the peak performance of the S&P 500 for that year. So you're consistently top ticking the market every single year. You put money in at the high water mark every year, which would be, again, historically and statistically almost impossible. But let's just say you were that unlucky, you still would meaningfully outpace investing the same amount of money into T-bills on January 1st each year. So setting it and forgetting it, consistently allocating money to the market, and trying to avoid all those different panic attack scenarios is the absolute way to go. History shows that. All these slides that we talked about show that. And just looking at it the most simplistic way, we're looking at 98 calendar years worth of S&P 500 returns on this slide. And what you'll see here is that the market is kind of skewed in your favor. Excuse me. So you have way more positive return years than you do negative return years. In fact, the market's almost 3 out of 4 times going to be a positive return year since 1926. So that, I mean, to me, there's no odds even close to that in a casino. It's not gambling in that way. Sometimes people think of investments that way, but this is a great chart that you should have pop up in your mind when you think about it like that, because the historic odds are on your side. Typically, you get positive return years 73% of the time. And you'll notice you have meaningfully more high return years where the market was up over 20% in a single calendar year, than you do ultra low return years. We only had 6 years where we had a calendar year where the market was down over 20% in this 98 years of data. And you had 37 years where the market was up over 20%. So again, a nerd, maybe not me, but a nerd would call this skew. You want to look for something where you have more upside than downside. And historically speaking, the market does offer that. History is no indicator of the future always, but historically speaking, that's how it looks. Now, that's just a way for us to set up kind of the beginning of the presentation to articulate why all this is so important, because investors, if left to their own devices, do a pretty poor job of compounding wealth. You have to look past the noise toward the signal. In our opinion, the signal is a recession. You want to try to avoid having meaningful risk-on exposures headed into a recession. And as was mentioned at the beginning of our call has been recession for a little over a year now. And now that picture is starting to get a little bit more muddy. Our probability of recession over the next 12 months has come down meaningfully to about 55%. So we still believe it's most probable that we go into a recession, but those odds have been coming down. And we'll get into why that is. But a lot of people over the last year have been saying, well, we've got, a lot of strength in the economy. We're not really super worried about it. We think we're going to have a soft landing. We don't think we're necessarily going to go into a recession. And as you can see on this slide, what we did was we looked at all the earnings transcripts going back to the 1995, and we looked for specifically the mention of soft landing. And as you'll see on the slide, these gray bars are recessionary timeframes. Typically headed into a recessionary timeframe, CEOs and CFOs in their quarterly earnings calls start to use the language of soft landing much more frequently. So we've seen that here recently. A lot of CEOs and CFOs are on their calls saying, we believe we're going to go into a soft landing. And usually that is kind of a telltale sign that it's unlikely that we're going to go into a soft landing. We're going to actually have an ultimate recession. So the fact that so many people are talking about it doesn't mean it's more probable. It actually, history would indicate that it's the opposite. But we also have strength in things like jobs and the consumer that people are pointing to as the reason why they don't believe a recession is more probable. And we'll look over the next 3 slides that is actually not the greatest way to contextualize what's going on in the market, because usually you see a lot of economic strength headed into the recession, and then it drops off very quickly as that recession materializes. So we're really strong right up to the point where we're not. So using near-term strength as justification to say that we're not headed for a recession historically is inaccurate. And what you're looking at on this slide is jobs, and next we're going to talk about the consumer. So jobs on average tend to be very strong in the 3 to 1 quarters prior to that actual recession materializing. And it's not until after that recession materializes that jobs start to contract. So again, looking at recent job strength, which we note on the chart has been very strong, over 200,000 jobs in non-farm payrolls. That's great, but it doesn't necessarily mean that a recession is not on the horizon just because we have near-term strength. Next, we're going to talk about the consumer. Similar thing, real consumer spending, and that would be a big one for us because consumers roughly 70% of our GDP. As you head into a recession, you can see in the 2 quarters out, you tend to have pretty strong median consumer spending, and close to 88% of the time, it's positive growth from the prior quarter. And then you can see the next quarter, you have, again, strong positive growth 100% of the time, going all the way back to the late 60s. And the median growth is almost 2%. But it's not until you actually hit the recession that you start to see a mixed bag of signal, where sometimes real consumer spending starts to come down, and sometimes it stays strong. But in almost every instance, it moderates. That growth rate moderates lower, except for one instance in the 90s. It moderates lower. And then 1 quarter into the recession, it always moderates lower, going back to 1960. And much more often, it's going to be negative. About 75% of the time on this chart, you saw a negative or a contraction in real consumer spending. So the fact that consumer spending continues to be strong doesn't necessarily mean that we are out of the woods or a recession is unlikely to materialize. And then lastly, GDP, which kind of aggregates the 2 things plus a couple other things into one number. The 2 things that we just talked about plus some other stuff into one number. GDP has been very strong. So folks will point to that as justification that we're not going to a recession. The economy is doing really well. But again, just like we talked about in the prior 2 slides, that doesn't necessarily mean that a recession is not going to come, because history would indicate that the economy tends to do very well headed into a recession. And then it's not until the 1 quarter prior to that actual recession materializing that GDP starts to fall off a cliff. So again, strength can last very long into the economic cycle. And it's not until the very end of that cycle where you start to see cracks really form in the economy. So we try to look at 12 leading economic indicators to contextualize all these things to kind of give us a genuine signal. And that's the ClearBridge recession risk dashboard that we're looking at right here on this slide. So these are 12 mostly leading economic indicators designed to give us a lead time into when recession is materializing in the US economy. It's broken up by the three major fault lines of the economy. On top, you have the consumer, which I mentioned a moment ago is roughly 70% of our economy. So that's a really important group of data points. Beneath that, you have business activity. Beneath that still, you have financial stresses, all of which historically have done a really nice job of showcasing when stress is building on the horizon, such that you can maybe de-risk your portfolios in advance of that stress. Now, we, as mentioned earlier, we have been on an overall red signal, which is an amalgamation of all these different 12 indicators in one signal. That overall signal has been red for over a year. So we have been saying that a recession is likely for over a year. However, since that signal went red, our strategist, Jeff Schulze, had compared it to the 1990s style of recession, where it was the longest red signal in all of our historical data. And again, this data goes all the way back to the late 1960s. And what he compared it to over a year ago was this 1990s timeframe. And that was an over a year red signal where you had this very long, drawn out slowdown in the economy that ultimately materialized into a recession. We believed at the time that that was going to be very similar. We thought a recession was going to materialize in the fourth quarter of last year. So putting that in more straight talk, we have officially started being wrong since the fourth quarter of last year. So we've been wrong for about a quarter now. And what we've gotten wrong, we're going to discuss in a couple of slides. But historically, this dashboard has done a really nice job of showcasing when stress is building on the horizon. And that red signal tends to materialize about 3 months prior to an actual economic recession, but it varies. I mentioned a moment ago, this 1990s was the previous longest red signal. And if we do ultimately see a recession, this current dashboard would actually take its place as the longest red X on the dashboard's history. So with that, I'm going to talk about why we have been officially wrong in terms of our call for a recession, and why we continue to believe that the odds are a 55% probability. So initially, interest rates started hiking right here. And essentially what we're looking at on this slide is the Fed, the monetary policy in the US, being accommodative, which is to say that are they stimulating the economy and stimulating growth and allowing liquidity to flow freely within the system? Or in the red zone, that's when they start to get restrictive. They're taking liquidity out of the system and trying to slow the economy down. And they did that to try to slow down inflation. Now, they started interest rate hikes here in March of 22. When they started, what we didn't appreciate was how deeply accommodative the Fed was at the time. So if you look at inflation plus the neutral rate, you were almost at a 5 plus 6% accommodative policy. And despite that being the second strongest start to a interest rate hiking cycle in our history, it still took almost a year for us to get into restrictive territory. So many folks last year were saying, why was the Fed so aggressive in the year prior with jacking up interest rates and throwing everything into a tailspin? This chart hopefully contextualizes it for everyone. They needed to be, is the short answer. And we didn't appreciate how deeply accommodative the policy was at the time when you incorporate the neutral rate. So putting this differently, we have only been in restrictive territory since basically the beginning of 2023. So the idea that the economy has been long in this restrictive territory, it was quite frankly wrong. So it took a long lag for that restriction to actually come through, despite the Fed acting as aggressively as they did. And now you're starting to see a little bit of a mixed bag in terms of what that means for the economy. Usually, when the Fed is putting the dampers on the economy, the government is doing similar actions in terms of monetary and fiscal policy. But what we've seen this go around, this is the other reason we got it wrong, is there was a massive fiscal impulse. So usually as the economy is doing well, employment is, you have a tight labor market, the deficit starts to come down. And we've had a very tight labor market throughout this entire time frame. The economy has been doing well. You would believe, if history is any indication, that the deficit would have been coming down over that time frame, as it has throughout history. Typically, usually these two things, the deficit and the employment rate, are pretty tightly correlated. But it has not been the case this go around. You see this big disconnect. So we saw a massive fiscal impulse, tons of fiscal spending, and that has stimulated the economy further. And that was something we didn't anticipate and we didn't fully appreciate until very recently. And so that's another reason why this slowdown has been more elongated than we believe. But it's not just our 12 dashboard indicators that have been signaling a recession's on the horizon. If you look to other sources of information like the Conference Board Leading Economic Indicators Index that we just put up here, that also has been showcasing a recession in somewhat historic fashion. So usually when the Leading Economic Indicators Index is negative, and this is, by the way, the subcomponents of this, there's 10 different indicators that they look at, which some are the same as we look at, some are different. But this has been around since the 60s. And it usually does a really nice job of showing you when stress is building such that a recession is coming. And usually, if this is negative for 4 months, it means a recession's likely on the horizon. We've been negative on this reading for 20 months, which puts us into pretty rare air, similar to 2007, 2008, and the mid-70s, which both preceded recessionary periods. Now, it doesn't necessarily mean we're going into a deep recession like those two. We don't believe that to be the case. I have long been saying that we believe we're headed for a short and shallow recession. Our strategist is also saying that at this point. So if we do see a recession materialize, given kind of the strength of the underlying economy as we head into that recession, we don't believe it'll be a deep, pronounced recession. So I don't want this slide to scare anyone, but we do still believe that a recession is the most probable scenario. Again, a 55% scenario. Part of why we believe that is the consumer is still under stress. The consumer's in a good spot, but you're starting to see lending standards retrench, which is what you see on this slides. You're starting to see delinquency rates go higher. And this is in part due to the fact that interest rates went higher. So the cost of debt has gone up and the availability of that debt has gone down. And as a result, you're starting to see delinquency rates come up for pretty much every asset class, except student loans has been pinned low artificially. As those have come back to collections, those will likely start to come higher. And then home equity line of credits have been pretty low. But outside of that, pretty much every other category is starting to tick its way higher in terms of delinquency rates. What would stave off an economic recession or start to stimulate the economy? This next slide has a lot of stuff on it, and it's pretty much just to say that if the Fed starts to cut rates, you should expect that the economy starts to reaccelerate. It's probably the most obvious slide with the most stuff on it, maybe the most unnecessary, but it's still worth pointing out that if the Fed does ultimately cut rates and have a sustained cutting cycle this year, you should expect the economy to start to reaccelerate. The other thing is inflation is no longer a primary concern. You can see we're at a much more manageable level. The core PCE has come down to sub 2% on an annualized basis, which is to indicate that the Fed is kind of on track with their average inflationary target of 2%. So a lot of work has been done there to bring that into line. We're not completely out of the woods yet, but we're starting to get to a point where cuts are definitely more probable for this year. I don't know if it's going to be as many as the market's currently pricing in, but we do believe cuts are on the horizon this year. So we're starting to get into the point of the presentation where we're 55% chance of a recession, but we're also 45% chance that there's not a recession. So now we're trying to talk about what would have to happen for that to materialize, and more aggressive cuts is a big part of that conversation. Also, you're starting to see job openings versus unemployed start to moderate. So we've been in this ultra tight labor market, but the unemployed have kind of moderated pretty meaningfully and kind of stayed flat, while job openings have started to come down, which is putting less pressure on wages for employers. So if job openings are coming down, there's less options for existing employees. And as a result, you don't have that big inflationary pressure of wages going higher every single year in the way that they have been over the last couple of years, which should be a positive for the overall economy. And you're starting to see kind of a better balance in terms of the labor force dynamics. So, labor, the employment side, the labor side is starting to look a lot more healthy than it has in recent time. And consumers are much less rate sensitive. So a lot has been made about the debt burden that consumers have. We even just talked about it in terms of the delinquency starting to go higher. But the biggest portion of consumer debt typically is their mortgage, the value of their home. Typically, the U.S. consumer carries a lot of debt, the majority of their debt as a mortgage. And historically, you could see a lot of the mortgage rates effectively are very, very high. So that debt is a burden to people over time, especially in more lean recessionary times. And add to that, when they're not fixed rate mortgages, which headed into the global financial crisis in 2007, 2008, a lot of mortgages were adjustable rate mortgages. So as interest rates went higher to fight the recessionary period and kind of cool off the economy, you basically consumers their debt burden was going higher and higher and higher. And that's a really, really disastrous scenario. Contrast that with today. Over 90% of mortgages outstanding are fixed rate mortgages, 30-year fixed rate mortgages, and the average effective rate on those mortgages is about 3.7%. So people are in a good spot in terms of their interest burden. However, any new mortgages, any new home buyer, you're looking at something in the 6-7% range. So that's a little bit cost prohibitive, and new home purchases is a big leading indicator for economic activity, which is something we're watching pretty closely. But services are holding up. So if you look kind of at the share of U.S. consumption as percentage, a third of it is goods, 2/3 of it is services. So we are a services-based economy. And you can see on the right-hand side, both of these have slowed meaningfully in the last 2 years. But services have been, after coming down quite a bit, they've been somewhat resilient. The trend is still a little bit lower, but they've been resilient, whereas goods have come down meaningfully. And that makes sense. Think about it from your personal perspective. If you were home during COVID, you probably bought a Peloton, you bought workout equipment, you bought a new monitor, a new TV. Those are all goods. The purchases on that side of the ledger have drastically reduced, and people are spending more money on experiences, going out to eat, etc. So that's pretty much the economic side. Again, we believe a recession is most probable by a slim margin, 55% chance. And then really quickly, I wanted to touch on the market side. What does this all mean for your investments? So you're seeing this economic activity start to moderate, which we talked about a little bit. So GDP is expected to continue to worsen. However, EPS growth rates for the S&P 500 are expected to continue to go higher over the next year. So just because the economy is starting to slow does not necessarily mean that the market is going to go down. We had a really big year last year. If we do have a recession, you should expect markets to be down. On average, as you hit a recession, markets are down about 30%. We don't believe we'd be down anywhere near that because of some of the strength that we talked about. So this is just a historical average. Half the time you'd be better than that, and we do believe we'd be on the better side. A lot of people make a big deal about the Magnificent Seven. It's a dot-com bubble all over again. We do not believe that. These are better companies in terms of profitability. Their return on equity is meaningfully higher than what you saw in 2000. And their valuations, although lofty, are meaningfully lower than what you saw in 2000. So the valuations and the earnings that these companies have are, dictate a little bit of a premium. So we're not as concerned about that. But headed forward, we would absolutely tell people to look to diversify their allocations. Own a high-quality dividend growth portfolio. Dividend growth is the way to be in an environment like this, headed out of an interest rate hiking cycle. Dividend growers tend to outperform the S&P 500 in the 3, 6, 12 months following that. And the fact that the market has been so concentrated, like we can see on this slide, really shows you that a diversified dividend growth portfolio like ClearBridge's dividend strategy is a fantastic way to keep allocation to the S&P 500, but realize that these Magnificent Seven stocks can't grow to the moon. We had the biggest outperformance of sort of a cap-weighted index since 1998. That is to say that the Magnificent Seven really are driving the entirety of the market performance. Looking at that differently, this is last year's performance broken out by the Magnificent Seven stocks versus in gray down here, the rest of the S&P 500. So the rest of the S&P 500 was up about 10%, and these stocks were up almost 80%. So it was really a bifurcated year where a handful of stocks did really, really well, and the rest of the market just did okay. You should look to own the rest of the market at this point. If you own those stocks, I wouldn't sell them. They're, you know, you'd have to, there's some idiosyncratic stuff within there, but for the most part, they're really high quality stuff. You just don't want to own only them headed into this market. And then what could drive the market higher? Cash. Think about, I'm sure everyone can identify with this slide. We have seen a record over $1 trillion in money markets over the last year. It is a massive percentage of people's overall allocation is just parking money in cash. When those interest rates start to come down and you can't get 5% on an enhanced cash savings account or whatever, a CD or whatever vehicle you're using, it's going to stimulate people to put that money back to work. Again, we believe interest rates are going to come down this year, and you've got over $1 trillion of dry powder that could come back into the S&P 500 or other equities and push those higher. Value underperformed growth by the second largest margin in 25 years. Large cap value, ClearBridge has a killer large cap value portfolio or value equity portfolio, which is a little bit more on the risk curve. You want to own something that's value, which is not something that people have been doing for a long time, but it's again something we think is really topical right now. A large cap growth portfolio that's biased toward quality, not toward momentum, is really positive right now. So we have a killer large cap growth portfolio that's had a great year last year, but in the couple years prior, it had underperformed a little bit because we're not momentum investors. We're not going to chase these high momentum stocks. And we do believe that investment discipline is going to come more into vogue, given all the things we've discussed. So that is all to say, we believe we're in a new secular bull market. Even if we go into a recession, these are 10 to 20 year periods where the market puts in massive cumulative gains. Do not let any near-term confusion keep you away from the markets. We think that the markets, even though if you see a recession, you'll see volatility. As we talked about at the very beginning of the presentation, that doesn't mean you shouldn't have skin in the game, because usually trying to time the market is a fool's errand. So just to wrap, we think a recession is the most probable scenario, but that probability has come down pretty meaningfully over the last quarter. And we talked about what could go right for the market and the economy. So 55% chance of a recession at this point. And then on the market side, we believe this year will be somewhat modest returns, but for the overall index. But within the index, there are a lot of stocks that have been the market has basically looked past. So look to value, look to high quality, large cap growth, look to dividend growers in particular as the thing you want to invest in at this point in the cycle. So with that, I am going to stop and say thank you all very much for having me on the call. I really appreciate the time. I'm going to turn it back over to Neil to close this out.
Hey, Corey, thank you very much. This was great information. We know this is really challenging, and for our secure planning group clients, we talked about this on a continuing basis. And I want to thank for our secure planning group clients for having faith in us and thinking, and please think about our conversations we've had over the last year, where we've talked about how we've looked at the market, how we've tried to adjust if we needed to, but also I'm sure the advisors have also discussed about continuing to invest dollar cost averaging into your 401s, into your IRAs, into your after-tax accounts. As a firm, we grew over the last few years. We're now up to 12 advisors, and our ranges are between mid-50s and early 30s. And so we are taking into consideration how we want to grow as a firm and continuing to support you and your family. So thanks again for joining today. If you have any questions about today's seminar, please reach out to your advisor. Talk to them about it. I'm sure there's questions here that we could dive deep into. So thanks again for joining on. Have a great day.